Hey, welcome back. Here is a statistic that should stop every trader in their tracks. 90% of traders lose money. Not beginners, not just people who are new to trading. 90% of everyone who actively trades, including people who have been doing it for years, consistently lose more than they make. Now, here is the question nobody asks. If trading strategies, chart patterns, indicators, and technical analysis are all publicly available, why are so many people still losing? The honest answer is this: the problem is almost never the strategy. Most losing traders actually have decent strategies. They know about support and resistance. They understand risk management rules. They have read the books and watched the videos. But they still lose because they cannot follow their own rules when real money is on the line and their emotions take over. Trading psychology is the missing piece that almost nobody talks about seriously. It is the difference between knowing what to do and actually doing it when it counts. Today, we are going to go deep into the psychological reasons why 90% of traders fail. We are going to name every trap, explain exactly why your brain works against you in the market, and give you the practical solutions that actually fix these problems. Let us get into it. The brain is not built for trading. Let us start with something most traders never consider. Your brain is not designed for trading. In fact, the instincts that helped humans survive for thousands of years are almost perfectly designed to make you lose money in financial markets. Here is what I mean. Human brains are wired to avoid loss more intensely than they pursue gain. Studies in behavioral economics consistently show that the pain of losing $100 feels roughly twice as strong as the pleasure of gaining $100. In normal life, this makes sense. Losing your food source or your shelter is catastrophic. Being cautious about losses is a survival instinct. But in trading, this wiring destroys you. When a trade goes against you, your brain screams to hold on and avoid accepting the loss. It tells you the price will come back. It tells you taking the loss makes it real. So you hold a loser far longer than you should. When a trade goes in your favor, the same brain screams to take the profit now before it disappears. It tells you to lock in the gain while you can. So you exit winners far too early, cutting off the full potential of good trades. The result is a trader who holds losers too long and cuts winners too short, which is mathematically the exact formula for losing money consistently. The first step to fixing your trading psychology is simply accepting this truth. Your natural instincts are working against you in the market. Profitable trading requires you to act in ways that feel deeply uncomfortable. That discomfort is not a problem. It is actually a signal that you are doing the right thing. Fear of missing out. Reason number two: fear of missing out. Almost every trader has experienced this, and almost every trader has lost money because of it. Here is how it happens. A coin starts moving fast, 10% in an hour, 20% in a day. Everyone on social media is talking about it. People are posting their gains. The excitement is contagious, and you feel an urgent, almost physical need to get in before you miss even more of the move. So you buy without analysis, without checking the structure, without calculating your risk. You just buy because everyone else seems to be making money and you cannot stand the idea of missing it. And almost every time you buy near the top of the move. Because by the time everyone is talking about it and posting gains, the move is usually almost over. Then the price reverses. You're now holding a loss on a trade you entered without a plan and without a stop loss. FOMO is not a personality flaw. It is a deeply human psychological response to social signals and the fear of being left behind. But in trading, it is one of the most expensive emotions you can have. The solution is a simple rule that you write down and read before every trading session. If the move already happened before I had a plan for it, it is too late. I missed this one. There will always be another opportunity. The market never runs out of trades. There will always be another setup, another coin, another move. The one you just missed is never the last one. Patience is not just a virtue in trading, it is a competitive advantage that most traders never develop. Revenge trading. Reason number three, revenge trading. This one turns single losses into account destroying spirals. Here is the pattern. You take a trade, it hits your stop loss. You are frustrated, the loss feels unfair, your ego is bruised, and immediately, almost automatically, you open another trade to make the money back as fast as possible. But that second trade is not based on your analysis. It is not based on your strategy. It is based entirely on frustration and the emotional need to recover the loss quickly. That second trade usually loses too. Now you are down two losses. The frustration doubles, and the temptation to open a third trade to recover both losses is even stronger. This is the revenge trading spiral, and it is one of the fastest ways to turn a small, manageable loss into a session destroying catastrophe. The root of revenge trading is treating losses personally, as if the market did something to you that needs to be corrected. But the market did not do anything to you. A losing trade is just part of the process. Every professional trader has losing trades constantly. The difference is they do not react to losses emotionally. The solution is a hard rule. After any losing trade, you close your charts for at least 30 minutes. You step away from the screen, you go for a walk, get a glass of water, do something physical to break the emotional state. You come back with a clear head. You only take the next trade when it meets your full criteria, not when your emotions are demanding action. 30 minutes after a loss, every time, without exception. Overconfidence after winning streaks. Reason number four, overconfidence. And this one is sneaky because it does not feel like a problem when it is happening. You have just had 5 winning trades in a row. Your strategy is working perfectly. Your analysis has been sharp, and you start to feel like you have the market figured out. And that feeling is when you become most dangerous to yourself. Because overconfidence leads to three specific behaviors that destroy accounts. First, you start taking larger position sizes than your rules allow because you feel like this trade is definitely going to work. Second, you start accepting lower quality setups because your recent success makes everything look like a good opportunity. Third, you start skipping parts of your process. You stop checking all your confluence factors. You stop calculating risk to reward as carefully. You feel like you can just feel the market now. And then the inevitable loss comes. But because your position sizes were larger and your setup quality was lower, that single loss wipes out multiple previous wins. The solution is to focus completely on process rather than outcomes. A good trade is not a trade that made money. A good trade is a trade where you followed your rules correctly, regardless of the result. A bad trade is not a trade that lost money. A bad trade is a trade where you broke your rules, even if it happened to make a profit. Judge yourself on your process, not on your results from any single trade or any single week. No trading journal. Reason number five. Most traders have absolutely no record of what they are doing. They cannot tell you their actual win rate. They cannot tell you which setups work best for them. They cannot tell you what time of day they make their worst decisions or which emotional states lead to their biggest losses. They're flying completely blind, making the same mistakes over and over without ever realizing it because they have no data to show them the pattern. A trading journal fixes all of this. After every single trade, you record 5 things. 1. Why you entered the trade and what your setup was. 2. Where your stop loss was and where your target was. 3. What actually happened and what the outcome was. 4. How you felt before and during the trade. Were you calm, anxious, excited, frustrated? 5. What you would do differently if you could take the trade again. Then every single weekend you review your journal. You look for patterns. You look for which setups produce the best results. You look for which emotional states lead to your worst decisions. You look for rules you are consistently breaking. The traders who improve the fastest are not the ones who study the market the most. They are the ones who study themselves the most. Your journal is the mirror that shows you exactly where your psychology is costing you money. Without it, you're guessing. With it, you are improving with every single trade you take. Let me bring this all together. 90% of traders lose money, and the reason is almost never their strategy. The reason is psychology. Your brain is wired to avoid losses more than it pursues gains, which causes you to hold losers too long and cut winners too short. Acknowledge this wiring and train yourself to act against it. Fear of missing out causes you to buy tops without a plan and without a stop. Fix this with a simple rule. If the move happened before you had a plan, you missed it. Move on. Revenge trading turns single losses into account-destroying spirals. Fix this with the 30-minute rule. Step away from the charts after every losing trade before taking another one. Overconfidence after winning streaks causes oversized positions and low-quality setups. Fix this by judging yourself on your process, not your results. No trading journal means making the same mistakes repeatedly without ever realizing it. Fix this by recording every trade and reviewing it every weekend. Here is the most important thing I want you to take away from this video. Trading skill is not just chart reading. It is not just strategy. It is not just risk management rules written on paper. Trading skill is the ability to follow your rules consistently when your emotions are screaming at you to break them. That ability is built slowly. It is built through screen time, honest journaling, uncomfortable self awareness, and the willingness to treat your psychology as seriously as your technical analysis. The traders who make it long term are not the ones who never feel fear or greed or frustration. They feel all of those things exactly the same as everyone else. The difference is they have built systems and habits that prevent those feelings from controlling their decisions. You can build those same systems. It starts with understanding exactly why you lose. And now you do. If this video gave you genuine clarity on the psychological side of trading, please hit the like button and subscribe. This is the kind of content that genuinely changes how traders think and operate. Drop a comment below and tell me honestly, which of these 5 psychological traps has cost you the most money? I read every comment and I will give you specific advice for your situation. I will see you in the next one.